Welcome to the Daily Update. This is Being Prepared Wednesday, April 20th, where we'll look at the action in the market today and then see how things look for Thursday, April 21st. And it was a really choppy day. It was kind of like Monday. We went up a little bit, down a little bit. By the time everything was said and done, we really didn't go anywhere. So what are some of the things that happened that day? We did have a gap higher right at the open, so I'm like, okay, it's looking pretty positive. But then we saw immediate selling that took prices down, and throughout the day, it was really choppy price movement. We ended up testing the intraday high multiple times throughout the day. As the day got closer to the close, we saw some late day buying, but then we saw some even later day selling into the close, and we ended up being down 0.06% overall. Volume continues to be below average, and what we're looking at are the technicals, and they are still negative, but showing some improvement. People are still really worried about inflation and interest rates, the different geopolitical concerns, and then we're seeing some, I'm calling it earnings shocks and surprises. And this is kind of roll of the dice type thing. I mentioned in yesterday's video that sometimes there's buy the rumor, sell the news. Well, that's a prime example of what we saw on Netflix. They had really run up the price going into the earnings report. The report comes out and bam, it's down 35%. Now, most stocks don't really react that way, but that's a very typical scenario that can play out. What are some comments that we can make? The technicals do remain negative, but they're showing some improvement, and I'll go through the charts. The 10 to 5 yield curve has gone inverted again. Now, we're going to have to wait and see. Is this just a short-term condition for this particular yield curve? Are other yield curves going to go inverted? Is this yield curve going to go back to normal pretty soon? We'll just keep an eye on it day by day and see how things go. And then Netflix really dominated the news with a drop of over 35%. The economic reports that came out really are showing a continuation of a slowdown in the real estate market. Existing home sales declined, and a lot of people are citing rising interest rates as well as inflation concerns. And then every week there's the MBA mortgage applications index. That also decreased. Our trend is still trendless. The ADX is below 20. I've switched the bias over to mixed right now. We're with 2 days out of the 3 that we've traded so far, we're ending almost unchanged. That shows real indecisiveness. And the one day that we had the strong day yesterday, that just bumped us right back up into a range where we've already been. As far as the momentum, we're still negative overall. But I've also added mixed because we had that strong day on Tuesday. We can't just throw that aside. So let's go through the day's session. First, looking at sentiment, seeing a little bit of an increase in fear, but it's still more in the neutral category. And here's the chart of fear and greed over time, just to let you know where we are currently at. And please disregard this. That was part of my screenshot right there. The VIX did decline. Even though we were down just a little bit, it declined on a closing basis. And the bar, we're getting back down to close to 20. Above 20 is when we generally say we're in a more fearful environment. But we spend a lot of time above 20. That's why I also plot the moving averages. They're more fluid. They can look at things over time. So that's why I look at both of these. Then as far as the VIX of the VIX, it also declined on a closing basis and closed not at the bottom, but kind of in about the middle. But it's just showing a real slowdown of volatility right now, which is pretty true of a sideways market. That's what you'll see a lot. Our Ulcer Index, it's declining a little bit. It came down somewhat after Tuesday's big up move, and it continues to fall after Wednesday, which is showing that fear is decreasing. And that kind of goes hand in hand with what the VIX is showing us right now. As far as the sectors, since we had just a slightly down day, that's the way I sorted it. Communications got hit the most. Most of that was Netflix. And discretionary got hammered. And there were really no strong sectors overall. Staples were up 1.5%. Healthcare was up over 1%. Real estate was actually up a little bit, even though some of the reports that came out are showing a decrease. It's because it's kind of what the market expected. So it's when the reports come out that catches the market off guard. That's when prices can gyrate a lot more. Here's our sectors showing that energy is still way in the lead, followed by utilities. And then way over at the end, we have communications in last place, followed by tech, and then discretionary. Here's the tech sector. It was down 0.09%, not very much. But this is not a real healthy looking chart. We're below the moving average, and the moving average is flattening out. The SOX index. This makes up a big part of the tech sector. It was down 0.22%. Also, a recent death cross and not a real healthy looking chart at this time. As far as inflation, the CRB was up a little bit, but we're still in that overall uptrend. And these are the commodities. These are the things that are used to make the products that we have to go buy. And if their prices are going up, that means ultimately our prices will go up as well. Here's the CRB in relation to the S&P. It shows how the CRB has been really outperforming. This next chart shows how the S&P has been really underperforming pretty much. Well, this started back in 2021, but we're really seeing it more noticeable into 2022. As far as the technical alerts, real estate, it had a bullish 50-20 simple moving average crossover. So that's pretty cool. And the Dow was able to get above 35,000. Financial sector had a bearish 50-20 moving average crossover. And then the Nasdaq first fell below 13.6 and then 13.5. Here's the intraday chart. Really choppy, way over on the right-hand side. We had a nice big green bar here. And I'm like, okay, here we go. Well, the next 10 minutes we sold, and that took us all the way down to unchanged. Actually went negative a little bit. And the buyers come in, took us back up to the high, kind of near the high that we had already set. Then we fell back, chopped a little bit sideways. Then we blocked our way back up to retest the high again. Here's the late day selling that came in. Then we saw a little bit of late day buying, and then right the last 10 minutes, we saw selling coming in. So this would make you pretty seasick if this was an amusement park ride that you might enjoy. Here's how it looks on the daily chart. And this is somewhat positive because we're seeing a little bit of a breakout. Even though we closed down slightly, the bar looks a little more healthy. Are we starting to break out of this range? That's what we're waiting to see. Because a lot of moves can really camouflage themselves really well. I'm not saying that's what will happen. What I'm trying to do is just explain that this can fool us. Just like a lot of people got really fooled by things back in the middle of March. We want to see some more strength to the upside, but we have overhead resistance. That's what these pink areas are right here. There's nothing special about them. These are lines or areas that I put on the chart myself. They're not indicators or anything like that. But we do have some pretty significant overhead resistance. And then here, volume was up slightly, but still below average. And we are down 7.03% from the all-time high. Here also shows that the S&P continues to be below the 200-day simple moving average. Then here's our growth and value. Growth down, value up. It outperformed. This shows growth decreasing in the ratio compared to value. This shows value increasing in the ratio compared to growth. Nasdaq 100 underperformed the rest of the S&P 500. Our pure growth index was actually down, where our pure value index was up 0.86%. Here's a ratio of the two, showing that growth has really been underperforming. Here's some ETFs that measure growth versus value, which are pretty much showing the same thing. Value has been outperforming growth. As far as our trend, here's the ADX. It continues to fall. We're now down around the 15 area. These lines are just about getting ready to cross. We'll have to see. what can happen? If the green line goes on top and the red line goes down, now we default over to a positive trend. What we want to see if that happens is a turn up in the ADX, cross above the moving average, and then see this start to move higher. That means that we are beginning a new trend. And if the green line's on top, according to this chart, it would be a positive trend. The Arun just really isn't doing much for us right now. Sometimes this is very insightful, so that's why I want to talk about it every day. Other times it's like, we've seen this story before. A decrease in selling, we were a little bit, decrease in buying, a little bit flat based on selling, but the overall oscillator declined slightly. Here's the decision point scorecard, really no changes there. As far as breadth, we saw an advance based on price and an advance based on volume. And if you remember, a couple days ago in the videos, I saw this positive divergence where we saw volume actually go up on Monday where price went down. Well, that could be feeding something into the market. Then the advance decline ratio, it shot up a little bit and is above 0. So this is more positive now. New highs, new lows, still negative, but starting to turn up. We saw a real advance in the new highs. So this is just showing a potentially improving internal situation inside the S&P. We're right on the line as far as accumulation and distribution. As long as we stay above that, it's more positive. Short term, we're kind of dancing back up with our 20-period moving averages. We're above, okay, thank you. We're above the exponential moving average, but we have not been able to get back above the simple moving average on the 20-period. 20-period moving averages did see an increase, as well as the 50 and the 200. So this is showing a little more internal strength inside the S&P. Our moving average tree, this is like, blah, 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 blah. That's why I call it a spaghetti tree. We've reclaimed a few of the moving averages, but we've got a lot more to do to have this a little bit easier to understand right now. The MACD still negative, but could be turning up. Swinlin Trading Oscillator, advancing and above 0 based on price and volume. That is more positive. McClellan Oscillator, also up, turned positive. Stoke RSI, coming off an extreme negative reading and advancing, short-term positive. Williams %R, same thing, extreme negative reading, still advancing, short-term positive. The Force Index is right around the 0 line here. It's really, it looks like it could go over and turn green, but it hasn't done so yet. Intermediate term, we're playing with the 50-period moving averages. We're above the exponential moving average, and we were able to reclaim the 50. So if we start going down, we want to watch this 50-period moving average. Now, a few days ago, the S&P just sliced through it really quick. Sometimes if we start heading lower, especially to the simple, this could act as support. Then here's the 100-day. We're above the pivot. We're still below both moving averages, but if we can stay above the pivot, that's a little bit more positive. Then the PMO study turning up slightly, but still negative, as well as based on price and volume. So see how this is getting, just showing a little bit of improvement here. Here's another PMO study. Those that are rising continues to go up. Those that are giving buy signals has turned up. And those that are above 0 is also slightly turning up. BPI, this is an index I rely on very heavily. These are point and figure buy or sell signals inside the S&P. We saw that advance on Wednesday. And this is just a longer term view of that same chart. Our rainbow is really kind of a mess here. In fact, I'm including some different rainbow charts. Way over on the right, I go anywhere from the 50 all the way up to a 250. Moving average to try to get a bigger picture look. Well, here we start at the 50 and I go 50, 60, 70, 80, 90, 100. This still doesn't look all that great, but because it's showing how we're rolling over with our shorter term moving averages. And then here's kind of the shortest term chart, 10, 20, 30, 40, 50. where it's a lot more volatile, and that's why I don't show it as much. Stochastics, short term, coming off of an extreme negative reading, as well as with the what I call the intermediate term stochastics, could be starting to turn up with the full stochastics. See, a little bit of positive stuff could be developing. Summation index has turned up based on price and volume. The momentum oscillators are still pretty much negative, but this top one, this is called slope, it is getting to an extreme negative reading and starting to turn up ever so slightly. We're not really seeing much of that. We're seeing a little bit of a rollover with some of our other momentum oscillators, but that top one, again, little bit of positive things coming out right now. The vortex saw a decrease in selling and an increase in buying, but the red line is still on top. So that's more negative. RSI slightly above 50 with the 14 and with the 9. And then the balance of power below the dotted or dash line here. So that's negative, but it is advancing slightly. And then here's the Connors RSI. It actually decreased, but it's still above this dash line. If we fall below that, that will be more negative. Our different trading systems, we're still positive with the S&P, with the Elders Impulse system, and with the SPY. We're still negative with the SAR, stop and reverse. The dots are on top. Our different charts showing some improvement with the Heiken Ashi, some improvement with the Kagi, still seeing something more negative with the Renko. These two red boxes were here after yesterday's session, so no new boxes were drawn. The 3-line break also showing some improvement. Equi-volume, seeing an awful lot of red candles. What we need to see are more green candles if you're bullish on things. And even though it's below the dashed line, the ease of movement did turn up slightly. Point and figure, no change here. It's still working off of a high pole warning. All these X's right here is the pole, and then we saw a decline after that. We're going to need to see some pretty big price movement for this chart to change, because it's based on how far prices move. It's not based on time. Long term, we continue to be below the 200-day moving average by about, I'm just quickly calculating, it looks like about 40 points below the moving average. So if we can recapture that, that would be pretty positive. The mega stocks down 1.25% overall. And the special K continues to drift lower. That's longer term. That's one of the longer term oscillators that I look at. And then our longer term moving average study shows an advance in the 50, an advance in the 150, and an advance in the 200. As far as the broad market, you see how we're looking to break out in the S&P, but then we've fallen back. We're seeing more of a breakout in the mid caps and even in the small caps. That's one chart that I've included. We want to keep an eye on the small caps. We saw back in the middle of March, we saw small caps break out just enough. And then shortly after that, that's when we saw the really nice run up in the S&P. Is that going to happen again this time? We're watching to see if that will happen. The composite was up 1%. This takes the trannies, the Dow, and the utilities all together, and they actually advanced. Then here's Dow theory, which shows the Dow was up, the transports were up, and utilities are still resuming their really strong upward move. FANG stocks got hit really hard because the N in FANG is Netflix, so it just got crushed. Just not a good day. Nor was it a really good day for ARC Innovation, down 5.93%. The Dow looking pretty good here, or at least better, I should say. We were able to get back above the 200-day moving average. So that was much more healthy. The Dow ended up being up 0.71%, much stronger move than we saw in the S&P. And our diamonds continue to be positive in the Elder system. Small caps also they closed just below the pivot. But this is what we want to watch for. Are we going to get a little strength from the small caps? And I'll have a chart at the end to show you that. Mid caps got right up to the 200-day moving average before it came back down, but this is also looking a little more healthy right now. And you want to see that. If the market's getting ready to go higher, you want to see people being willing to get into the small and the mid caps. They're not as established. They're not perceived as the blue chips, and they're considered riskier stocks because they're not as big. If people are willing to jump into some of those, that means they're willing to jump in and take some more risk. Then the Nasdaq, still having some trouble. It was down 1.22% and below the moving averages, as is the Nasdaq 100. It was down almost 1.5%. The Vixen, this is kind of strange here. We saw a decline now based on price for the Nasdaq 100, but we actually saw the Vixen decline a little bit based on the bar. That's kind of interesting. Not a lot of fear is being added right now. And the Qs are back to being neutral with the Elder Impulse system. NYSE, this is another positive thing. We're able to break above the 200-day moving average. Now, we didn't close at the high, but at least we closed above this green line here. And then the S&P 100 continues to underperform the S&P 500. The Wilshire also was able to stay above. This is a 50-period moving average. It would be a lot more positive, since this is a broad-based index, if we could get above the 200-day moving average. Internationally, China's having trouble. Everybody's having trouble right now. We're seeing kind of across the board weakness as far as trend. All stocks, they were up 0.09, but they couldn't even get back up to the 50-period moving average. The non-U.S. stocks, they declined almost 0.5%. Then looking at the dollar, it's just been screaming higher. So it was down about 0.5%. And as I record this, it's unchanged to slightly down. And here's the weekly chart thus far. It's still over 100. Oil closed at 102. It was actually up a little bit. And gold was little unchanged on the futures contract. It was up 0.5% in the ETF. And here's the longer term view of the gold ETF. Silver was up 0.17%. And here's the longer term view of the silver ETF. Bitcoin, which had been below 40, now is slightly above 40. It's in the 40 or 41s right now. And then this is the yield curve that went inverted. This is the 10-year to the 5-year, where you subtract them. And we're not very far inverted, but we still are inverted overall. And then the Fibonacci, we're still above the 61.8. We got up to 3%. Well, we fell back slightly on Wednesday to 2.9%. And then here's where the 10 and the 2 are just kind of kissing each other. So we saw interest rates come down for the most part. And then internationally, we're seeing the overall rise. And this is a weekly chart. So every day it's going to look different until that week is finished. Bonds actually bounced up a little bit, but they have broken major support based on price. And then this shows how the corporate bonds are also really having some trouble with the current yield at 3.94%. So that's why some people that are bond investors, they're like, forget this whole treasury thing. I'm going to go over and get some corporate bonds. I can get a much higher return. Yeah, I'm still not getting even half as much as the official inflation rate, but I'm getting a lot more than what I'd be getting with the ultra-safe treasury bonds. Here are junk bonds, up 0.25%, and their effective yield is 6.4. Still not outpacing inflation. So people that get into some of these funds, they think, wow, yeah, 6-7%. Well, what is it compared to the inflation rate? And then this is just the junk bond ratio against regular bonds or government bonds, where it actually declined a little bit with the ratio on Wednesday. Our relative studies just shows how Gold continues to outperform the S&P, but we've seen breakouts like this before. Is it going to come back down? Where energy, it's still looking pretty strong. This is a more solid breakout when compared to the S&P. This is energy against tech, where tech has really been underperforming and energy has been really the strong one so far for 2022. Here's growth against bonds. Both growth and bonds have been having trouble, so for this thing to just kind of dance around sideways is not a surprise. Here's tech against the S&P, where it came up actually declined a little bit right here. And it just shows how tech has been underperforming the rest of the S&P 500. Here's tech against the 10-year. This just shows when tech goes down, that's usually because interest rates are going up. Saw a little bit of a reversal in that on Wednesday. And then this is the correlation chart where the dotted line, that's the 10-year yield. The black line is the tech sector. And we've been getting close to this -1, which means an exact inverse relationship. Interest rates go up, tech goes down. Or tech goes up, interest rates go down. Well, we got really far to this reading. You never get to a perfect -1. Well, it's starting to turn back up a little bit right now, but we'll keep watching that. Here's the 10-year yield to the tech fund. Just shows how interest rates have really been going up as tech has been underperforming. Discretionary showed weakness when compared to staples. And then here's the S&P has really been underperforming the rise in interest rates. Here's the low volatile stocks. They were up 1.28%. Yeah, that's pretty cool. Then when you compare it to the performance of the S&P, they really are outperforming. So a lot of people are getting more into these low volatility stocks, thinking, okay, they might go down, but they're not going to go down as much as the highly volatile stocks, but you don't see as good a return as when the volatile stocks actually go up. And then this is the chart that I'm talking about. This red right here, this is the small cap index. The blue is the S&P. And you can see back in March, and it's a little subtle. It's not real easy to see this. We hit kind of a down point here. Well, we hit a down point right before that with the small caps, and then it started to take off. And then right after that was when we saw that really nice move up in March. It looks like we might be starting to bounce up out of this. Are we going to see a delayed bounce coming out of the S&P 500? Sometimes this really fits nicely. It did last March. Is that going to happen this time? We don't know. We just watch this to see. So if you're watching things during the day, keep an eye on the small caps. And then how are they doing in relation to the S&P? If the small caps are having a good day and the S&P is not really doing much, this scenario might seem more likely. If we see the S&P really going up and small caps doing nothing or actually going down, then the validity of this signal might really diminish at that point. And then the other thing we're watching are staples. A lot of times when staples have topped out, that has marked bottoms with the S&P. We don't really know right now because this thing keeps going up. It hasn't spiked yet. This could be a spike, but it could spike even higher. So that's why this is a delayed thing that we watch, because we don't really know this until we have a bit of hindsight. So what's our outlook then for Thursday? The technicals are negative, but showing improvement. The market remains trendless, and we're in that intermediate term range that goes all the way back to the beginning of 2022. The growth and value battle continues. The supply chain issues continue. We have initial and continuing jobless claims on Thursday. That can have a real impact if the number is just really off of what they're expecting. We've got the Philadelphia Fed index, and then we do have the leading economic index. A lot of people don't pay attention to that because a lot of the components are known before this thing even comes out, and it never really performs up to its name. It's supposed to tell us what's happening ahead, and unless it gives us a really screwy reading, the market really doesn't pay attention to that. We have all the different geopolitical events, Russia, Ukraine, China, and then their economy and what's happening there for its impact on the supply chain and how will that bleed over into the U.S. economy, inflation, interest rates, oil, and then earnings on a case-by-case basis are also can have an impact, especially when the really big companies come out. Okay, so what are our different scenarios? And I've actually tried to color code this a little bit. We are currently in a downtrend. This is the trend, this is the scenario that's being played out right now. Rising interest rates and inflation fears and earnings. That's really what's affecting things negatively right now. And our technicals are still, they're showing improvement, but they're still negative. The other scenario that's being played out right now is this yellow one, that we're neutral. The ADX is below 20 and it continues to decline. We're seeing a slowdown in price movement and a really choppy environment. What could happen to turn things back more positive? We do have this positive backdrop after yield curves re-invert. Okay, is that still on the table? What with this new inversion that we're seeing? Does that change things a little bit? We don't know at this point. And then the staples. After they spike, sometimes that can really push the S&P higher. But we don't really know for sure if they've spiked at this point. The technicals could be showing some improvement. The moving averages and different pivot points may provide either support or resistance, depending on where price is at the time. So really, I misspoke a little bit. 3 is what is being played out right now with a default, if we start trending again, to number 1. But if you're positive about the market or you want things to go up, you want to see these things happen for these things to turn more bullish. So our conclusion is the S&P is negative. Short term, it's negative, but possibly improving. Negative, but also we're seeing some improvement there. The oscillators are negative and below important moving averages. Long term, we continue to be negative because we're below the 200-day simple moving average. Here's just a shot of the different videos that I make available to you. So thank you very much. Have a wonderful Thursday, and I'll prepare the next video after Thursday's session.